I think all of you are aware of the interest rate cut of the Federal Reserve last month. Actually, the Federal Reserve has announced the 0.5% interest rate cut at the 18th of September. The 0.5% rate cut no doubt affect Hong Kong's economy in different aspects. First of all, as Federal Reserve has decreased the rate, Hong Kong should follow the action to lower down the rate. Therefore, there is a decrease in 0.25% rate in Hong Kong that match with 0.5% by Federal Reserve. Also, under the linked exchange rate system, as price of US dollars drops, Hong Kong dollar will also follow to drop. On the other hand, the 0.5% rate cut also stimulates the Hong Kong stock market. As interest rate is inversely related to level of investment, people will tend to invest more after the rate cut. Take Hang Seng Index as an example. It has been rising continuously from 25,000 upwards after the drop in interest rate, and the trend seems non-stop. Until 28th of September, Hang Seng Index has already risen up to 27,000. It's no doubt that the rate cut brings stimulation to Hong Kong stocks. In addition, after the drop in rates in Hong Kong, the inflation rate is higher than that of the rate of interest of the saving account. Under this condition, negative interest rate will occur in which interest rate can't match with inflation rate. Therefore, people who hold their assets as saving account will normally suffer after the rate cut. It is because their purchasing power in terms of their interest they get from the bank can't match with the inflation. As a result, liquid assets holders will suffer the most after the rate cut. The amount they lost will be the differences between the inflation rate and the rate of interest rate in saving account if they deposit their assets in saving account. Those who are holding their assets as real assets can avoid the loss from negative interest rate. In my opinion, under the existence of negative interest rate, people will think that as the return from deposit into the bank drops in terms of purchasing power, they will tend to make investment rather than just save their money into the banks. They will probably invest by buying gold, real estate in which values are not affected by inflation. With an increase in demand for these assets, the price of these assets will no doubt be raised. Last but not least, investors could be able to seek advice from different channels and finally make the best decision to capture their largest gain.